was a very pleasing result. I was sitting above consensus in terms of my earnings expectations, and they came in even 4% better than what I was expecting. So even a better beat on consensus than that. The interim dividend of $1.50 per share, that was just 1 cent shy of what I was expecting. That's a fully franked dividend. Now they'll be operating a dividend reinvestment plan with respect to this, with no discount to the price, but they'll be neutralising that DRP given the strength of their capital position. And maybe that's something that I'll quickly touch on. The CET1 ratio is 12.6%. There's roughly $9.5 billion of excess common equity Tier 1 capital at the moment that they've got above APRA's 10.5% unquestionably strong benchmark. And then you've obviously heard me say now that I've been expecting credit quality to hold up better than consensus expectations. We've started to see, we've definitely seen that come through the result yesterday. The asset quality is definitely looking better than consensus expectations, but there's a double benefit because not only does it help the provision outlook, but it actually helps the CET1 ratio outlook, given the way that the denominator of that ratio works. And so previously, if we go back to 30 June last year, CBA was expecting a 70 basis points hit to its common equity Tier 1 ratio over coming years as a result of negative credit risk migration into higher risk buckets, and that puts up that results in credit risk-weighted asset inflation, which brings the CET1 ratio down. So their base case scenario was a 70 bips adverse impact on the CET1 ratio. Their base case is now for no adverse impact on that CET1 ratio. And so I've revised my credit risk-weighted asset forecast accordingly, and so the risk-weighted asset inflation that I was previously putting through, I've now adjusted that according to CBA's revised base case scenario. So as a result of that, I've revised my credit risk-weighted asset inflation forecast, and as a result of that, I'm seeing more scope for capital management than I did previously. And so previously I was expecting $4 billion of off-market buybacks in FY22. I'm now forecasting $5 billion of buybacks in FY22 and another $5 billion in FY23. So I'm looking for $10 billion of off-market share buybacks over FY22 and FY23. So that's definitely a positive development, and that's got positive read-throughs for the other major banks because the other major banks may do a similar thing. So they may revise their base case scenarios for credit risk-weighted asset inflation similar to CBA, and that will result in the outlook of their CET1 ratios also looking stronger. So there will be scope for there will be potential for capital management from the other major banks as well. Just on the other points quickly with CBA, look, I was pretty happy with CBA at every level, at every line item, and the operating income was strong. The read-throughs for the other major banks here would be that the NIM has come in line with my expectations. I've been more bullish than consensus, so it's possible that not only after the trading updates from the other three major banks next week, not only may we see earnings upgrades as a result of bad debt charge revisions to consensus, but also NIM upgrades. So I have been more bullish than consensus on NIM, and CBA has come in line. So that gives me more confidence about my NIM forecast with the other major banks and my bullishness there. The other thing we've seen with CBA is they've had a strong markets quarter in the December quarter, and I think that bodes well for the upcoming December quarter trading updates as well. And CBA said that they saw particularly strong volume growth in home lending in the month of December, and that's carried through to January. So that bodes well for the December quarter trading updates coming up from the other banks as well. So positive read-throughs from the income side. On the credit impairment charge, on asset quality, as you know, I've been much more optimistic than consensus, and their bad debt charge has come in a bit lower than what I was expecting. So that's a good outcome. And even within the second half, so just to give you some numbers here, their bad debt charge as a percentage of their loan book was 48 basis points in the second half of FY20. That fell to 28 basis points in the September quarter, and it fell even further to 17 basis points in the December quarter. So that December quarter is really where the provision build is slowing down. And that's the period for which we're going to get trading updates next week. So it's that December quarter which is looking particularly good. So positive read through on that front as well from the major banks next week. So look, they're the key points. And what I've done overall is I've upgraded my cash EPS forecast for CBA by about 3.5% in FY21, 2.5% FY22, and 6% in FY23. The reason the upgrade is larger in FY23 is because I've got those larger buybacks now in my forecast. So I've got a much more reduced share count than what I did previously. So that puts up that EPS by 6% in FY23. My target price has increased to $68 from $64. I've got a reduced recommendation given that the stock is sitting at $86. Now I'm reiterating again. This is a relatively high quality major bank. Fundamentally, CBA is relatively sound, but the reason for the reduce and the target price is really really valuation grounds. Well, you've heard me talk about why I think CBA is overvalued, and that remains the case. So I'm preferring Westpac over CBA. I'm seeing value in ANZ still. I'm seeing good value in ANZ. NAB's looking pretty fully valued.